Good morning from HKCBA Toronto. My name is Zoe Hassanbai, your Master of Ceremonies, and Victor Ng is our Technical Director. Welcome to the Structuring Your Asian Business for Maximum Returns webinar. Before we start, I want to thank our sponsors. The Toronto office of the Hong Kong Economic and Trade Office, the Hong Kong Trade Development Council in Canada, Sonia Chong Professional Corporation, Ernst & Young, Hong Kong Corporate Services Group. We always appreciate your support. You really make a big difference. A little bit about Hong Kong Canada Business Association in Toronto. For 36 years, we've been expanding corporate strategic relationships between Asia and Canada, using Hong Kong as the platform. We have superb networking events to develop high-level business relationships throughout the year. We are honored to have several distinguished guests who would like to present opening remarks to our audience. I invite Ms. Emily Mo, Director of the Hong Kong Economic and Trade Office in Toronto, to say a few words of welcome. Emily?
Thank you, Sohail. Good morning, everyone, and good evening to Colin in Hong Kong. Thank you for having me today's webinar, which talks about how to maximize business return through Hong Kong. This year is certainly a very challenging year for business, but smart people see big challenges as opportunities. During the global pandemic, Hong Kong has been one of the most successful cities, maintaining our status as the international financial and business hub with relatively low number of COVID cases. In November, there have been some positive updates about Asia and Hong Kong. The Canadian retail giant Couche-Tard announced entry into Asia with the acquisition of Hong Kong's Circle K chain. The Regional Comprehensive Economic Partnership was signed lately, and Hong Kong is keen to be part of it. Also, Hong Kong and Singapore will launch the quarantine-free air travel bubble on the coming Sunday. With the rebound of business in Asia, Canadian companies should seriously consider diversifying your investment and business into Asia through the Hong Kong platform. A powerful combination of factors, our prime location, high-speed communications, free flow of information and capital, low and simple tax system, rule of law, etc., makes Hong Kong a leading international business and financial center, which definitely helps companies to maximize their return. Regarding some recent speculation of Hong Kong's rule of law being possibly undermined, I would like to clarify that the rule of law, as well as various legitimate rights and freedoms, are the fundamental core values of Hong Kong and are much cherished by the government and community. The recent introduction of the national security law and also some disqualification of electoral members in Hong Kong are all carried out in accordance with the law. As regards the tax system in Hong Kong has one of the most business-friendly tax systems in the world, according to the annual study of the World Bank and PwC. Only 3 direct and low-rate taxes are imposed, and there are generous allowances and deductions which can reduce the taxable amount. I'm sure that my colleagues from Invest Hong Kong, as well as today's wonderful speakers, will share you with their actual experiences and secret tips in this regard. So without further ado, I will thank you and hope all of you enjoyed this today's webinar. Thank you, Sohail.
Thank you, Emily. It's always good to have you on our webinars and to have such updates on Hong Kong. You mentioned that Hong Kong was the tax system is business friendly. In my mind, Hong Kong as a whole is business friendly. So thank you very much. I appreciate your warm greetings and your comments. Now we have a greeting, a video greeting from Mr. Stephen Phillips, Director General Invest Promotions in Invest Hong Kong. He is based in Hong Kong, and he has a video for us. Victor, when you have a moment, can we have the video, please?
Hello everyone, my name is Stephen Phillips and I lead the team at Invest Hong Kong. The Greater Bay Area is a national policy which foresees the closer economic integration of the 2 special administrative regions, Hong Kong and Macau, and 9 cities in Guangdong. And really what it underpins the idea is that within these 3 different jurisdictions, with 3 different legal systems, with 3 different currencies, that we will see the freer movement of people, goods, services and capital in the years to come. So unleashing the economic potential of the region. The strategic intents probably fall into 4 broad buckets. Firstly, innovation. Guangdong is already home to some of China's most innovative companies. Hong Kong is positioning itself, both on a policy and commercial front, to be the international innovation centre of the country. Hong Kong, of course, already the most international city within China, but through these combined efforts of the 11 cities, this region will become genuinely competitive on the global stage. Obviously, commerce and business is also at the heart of what's going on. It's to forge ahead with even more innovation, and it's to leverage the different systems and the great skills and talent that exists to really see the further development of world-class companies. But there's also the livability angle. This region is home to a population of 70+ million people, and it's very important that the quality of living, the healthcare provision, the education, and the cultural and lifestyle activities are commensurate with being such a leading cluster on a global stage. As I said, the Greater Bay Area consists of 9 cities in Guangdong and the 2 SARs of Hong Kong and Macau. What is interesting is these 11 cities already are equivalent to the 10th largest economy in the world. Actually, pretty much the same size as the whole of the Canadian economy. And in 10 years' time, GBA may well be within the top 5 economies globally. And if that isn't a good opportunity, I really don't know what is. So do look at what's going on in GBA to see if we can help you grow your business. There's lots of resources available on Greater Bay Area, but what we're going to be doing at Invest Hong Kong is really ensuring that we articulate GBA in the language of business. So our website will have resources for you to tap into that really help you identify where the opportunities lie. We'll be working with our counterparts in the other 10 cities to work to provide you with solutions that might allow you to do certain functions in Hong Kong and other functions in one of the other 10 cities. And then we're going to have a dedicated Greater Bay Area team within our Hong Kong office to really help you and indeed help us to understand what these opportunities are going to be in the short, medium and long term. So I'd like to conclude really by saying I think there is no more exciting development on the global landscape than Greater Bay Area. The team at Invest Hong Kong, whether it's Chris in Toronto or our teams in Hong Kong, would love to have a chat with you to see how we can help you capture these opportunities. And if you want to get in touch with me, you can find me very easily on LinkedIn. Thank you, and I hope you have a really fruitful dialogue. Thank you.
Thank you very much, Mr. Phillips. Very insightful, especially about the Greater Bay Area. In a short while, we will have Chris Chen, who will be offering a more detailed presentation on the Greater Bay Area as well. So please stay tuned. Now I'd like to introduce Sonia Chong, and our colorful moderator. The red color is very appropriate, Sonia. Sonia is the principal of Sonia Chong Professional Corporation. It's a professional chartered accountants firm. Her practice focuses on income tax planning for private corporations, high net worth individuals, cross-border estates, business succession, immigrants and emigrants, and real estate investments. Sonia served on the board of governors of the Canadian Tax Foundation and was a member of the Joint Committee on Taxation of the Canadian Institute of Chartered Accountants and the Canadian Bar Association. She also co-chaired the program committee of the Ontario Tax Conference for 8 years. She is HKCBA National's treasurer and our treasurer in Toronto as well, and the past president of the Toronto section. Sonia continues to serve on the board of the Toronto section. Sonia?
Thank you, Zohair. First, I wish to say that it is wonderful to see so many of you attending this tax-focused webinar. I have been told, not too subtly, to keep my expectations low regarding attendance, as tax topics can be dry, complex, and you know what, very taxing. Before we delve into the heavy-duty side of tax-effective structuring, let us put this entire thing of Canadians diversifying and investing into Asia in its proper context. As you're probably aware, recently the IMF projected that the world's cumulative GDP growth for 2020 and 2021 is going to be negative, if not for China. The IMF said that China's growth will accelerate to 8.2% next year. Hong Kong is the gateway to China. Thus, it is and will be part of the driving force of China's growth, particularly having been included in the recent Regional Economic Initiative of the Greater Bay Area. The Greater Bay Area is poised to be the most affluent area in Asia. With us today, to shed further light on this, is Christopher Chen of Invest Hong Kong, Canada. Let me tell you a little bit more about Christopher. He's the head of the Invest Hong Kong presence for Canada, operating from the Hong Kong Economic and Trade Office in Toronto. As Hong Kong's Trade Council and Commercial Representative for Canada, he is responsible for all activities driving new business development and direct foreign investment. Chris comes from a digital financial services background with over 20 years of experience living and working in Asia, including Hong Kong, Singapore, Tokyo, and Taipei, working for financial services multinationals and digital marketing consultancies. Originally from Vancouver, Chris is a postgraduate from the University of British Columbia with fellowships from National Taiwan Normal University and the ICS Yusof Ishak Institute in Singapore. You will find Chris to be a wonderful speaker with an abundance of energy, enthusiasm, and knowledge. Without further ado, here is our speaker of the moment, Christopher Chen.
Thank you. That's overly glowing, I must say. And thank you everyone for taking part in our presentation today. Let me put up a presentation. I don't want it to be too reminiscent of what the Director General Stephen Phillips and Sonia have both said in terms of espousing the benefits of the Greater Bay Area. I will touch upon it in some greater detail, but I also want to talk about the opportunities that Stephen have been talking about if you choose to expand your business into Asia Pacific via Hong Kong. So I won't go through a lot of this, but basically what I do want to bring up is that Hong Kong does have one of the best tax regimes in the world. It has one of the world's lowest tax jurisdictions and most business-friendly tax systems. I mean, this is one of the greatest opportunities for companies that choose to operate in a highly competitive region such as the Asia Pacific. Hong Kong does come from a very strong financial services background. It is well established as one of the best places to build a business and to grow your business, and as a hub for entering Asia Pacific. Not going to go too much into this, as previous two speakers mentioned the Greater Bay Area, but I do want to mention that it is the key wealth creation region in Asia. It is, in terms of a super economic region, it is on par with New York, San Francisco, Tokyo Bay. A lot of it is being driven by the high net worth individuals that are located in the Greater Bay Area, roughly 80,000 ultra high net worth families. And a lot of this has created the foundations for the asset management and wealth management industry that Hong Kong is known for today. Stephen had mentioned that in terms of GDP, the Greater Bay Area was on par with Canada. As you can see, if you look at rank number 10, it's ahead of Russia and South Korea. What he didn't mention was that by 2030, it is likely to slot into this the third or fourth position in terms of GDP. The Greater Bay Area is an area that is primed for growth and very little obstacles in its way. Going back to where Hong Kong stands in terms of its history, Hong Kong's bench strength by tradition is the financial services industry. It's been that way since the 60s and 70s. It's going to continue in that position of being one of the top three financial capitals, investment capitals of the world. Is one of the world's leading capital markets, first in IPO fundraising, largest offshore renminbi business hub. 70% of renminbi going from China to the outside world is funneled through Hong Kong, thereby creating huge concentration of both renminbi as well as the investment management expertise to capitalize on that. Hong Kong is actually the only place in the world with that amount of concentration of both expertise and capitalization. So any company wishing to tap into Chinese private equity, there is really only one place. It is a premier international banking center. It is a premier asset wealth management center in a dynamic insurance market. For a population of less than 7 million, it actually has a larger financial services sector than Canada. But what I really want to talk about is the opportunities of Hong Kong. And the opportunities stem from a closely calibrated government strategy. And the government strategy is mandated by the Innovation Technology Commission, which is a single-minded incentive program designed to increase Hong Kong's diversification away from financial services and into innovation and technology. Of course, Hong Kong is a financial center, and it's using that expertise to grow itself in the 21st century, but it's using that financial expertise and capitalization to diverse its industrial base. So the Innovation Technology Commission, which is a mouthful, the ITC, has itself manifested in something called the Innovation Technology Venture Fund, the ITVF. This is a roughly 13 billion USD venture capital seed fund dedicated towards innovation technology companies primed for growth, primed for expansion in the Greater Bay Area. However, the venture fund is just a fund. It's a public pot of money. The agents of disbursement are the different branches, agencies, and bureaus of the Hong Kong government, such as InvestHK, such as the Hong Kong Monetary Authority, such as the SFC, such as Cyberport and Science Park, each one of which is responsible for grandfathering, for shepherding companies going into Hong Kong or growing their business in Hong Kong into the 21st century. The lower half of the slide will show you the vast variety of different types of companies that are benefiting from the Innovation Technology Commission. I won't be going through all of it, but I will point out there are some strategic pillar industries that have seen a lot of positive attention, such as fintech or life sciences, biotech, artificial intelligence. Hong Kong does have the building blocks for growth, not just from government policy incentives. There's this snapshot of different potential subsidies and grants. There's a robust ICT infrastructure, a vast sourcing center for manufacturing, both advanced as well as traditional. The talent resources, the universities of Hong Kong are amongst the top in world rankings, citing HKUST, HKU, as well as research capabilities. If you think about the tech campuses such as Science Park and Cyberport, those are matched by actually applied science research institutes, the Productivity Council, ASTRI, NAMI. Each one, ASTRI, for example, focusing on engineering, nanotech, artificial intelligence, biotech, Productivity Council on technology transfers. There are those that specialize in automotive, the textile industry, retail. Here's a snapshot of a Hong Kong government funding scheme. If a company were to choose to go into Hong Kong, again, there is that concept of shepherding a company from all the way in its development cycle from a company startup, a setup. And any company that sets up, no matter how large, when they set up in Hong Kong, you know, it's pretty much denominated as a startup, all the way through R&D, hiring, business development, fundraising, and I think one of the most interesting ones, overseas expansion. If you're a company that's been there for about a year or two, and you're putting up your hand for further Asia-Pacific expansion, you can receive grants or subsidies from the government to aid in that overseas expansion. This amplifies Hong Kong's role as a hub for Asia-Pacific. However, everything I talked about previously was public funding. There are private capital sources, namely the venture capital industry, as well as the Hong Kong Stock Exchange. I cited last year that there was $12 billion USD total VC equity pumped into companies expanding in Hong Kong, 1.5 of which was dedicated to the fintech industry. And in terms of IPO fundraising, I don't even think I need to mention that Hong Kong has placed number one 6 times over the last 10 years in terms of total IPO funds raised. Hong Kong Stock Exchange is the place for secondary listings globally. So top motivations to expand into the Greater Bay Area. First and foremost, access to a larger market. It is a super economic region, 70 million people, wide access to customers and potential business partners. Top incentives to expand into the GBA. Based on our policies, there are new incentive programs for those who want to use Hong Kong as a hub and expand into the Greater Bay Area, such as a new method of calculating 183 days, tax relief for high-end talents, and supporting open recruitment, encouraging innovation, entrepreneurship, and so forth. There are policies to match with those incentives. Stephen mentioned this briefly, but I'll just touch on the ones on the left-hand side: facilitating general public to work, study, and reside. This makes a difference. This makes a huge difference for those residing in Hong Kong, even under work permits, that they're allowed to purchase properties, for example, in the GBA. You're allowed to remote open personal bank accounts, cross-boundary wealth management schemes, that means cross investments in financial investment vehicles across the border, and insurance policies being observed on both sides. So a little bit about us as I close this off. Who is InvestHK? We're not just a company that helps open up business registrations. Frankly speaking, anybody can do that. Our true value add is that we actually help facilitate the business networks, the partnerships, and the networks to actually grow your business. Asia Pacific is a very competitive place. Setting up a business in Hong Kong is extremely easy. It only takes 1.5 days. Doing well, ensuring that your business flies after it sets up, is an entirely different matter. In order for your business to survive, the Hong Kong government and the Canadian government want to ensure that every Canadian company that enters the Asia Pacific does well. And the way to do that is to establish the right networks. And InvestHK will help you establish those networks free of charge. The last slide is that just want to point out there's about 200 Canadian companies operating in Hong Kong. InvestHK put approximately 180 of them there, ranging from small startups to very large multinationals. If you are thinking of expanding your business in Asia Pacific via Hong Kong, please let me know. I believe you can contact HKCBA through here, or do a screenshot of this email and shoot me a message. Thank you.
Thank you, Chris, for providing us with the perfect background, leading to the presentation of a case study based on real-life experiences. This case study will highlight the unique features of the tax agreement between Canada and Hong Kong, as well as the practical aspects of CEPA, the Closer Economic Partnership Agreement between mainland China and Hong Kong. I am most pleased to introduce two tax professionals who have perfected the art of helping you maximize your international growth and return through the Hong Kong platform. They are both with Ernst & Young in Toronto. First, I'd like to introduce Leona Liu. Leona is a senior manager in EY Toronto's International Tax and Transaction Services Group, with over 10 years of corporate and personal tax compliance and advisory experience. She works closely with a number of global companies and assists both Canadian inbound and outbound clients on matters including restructuring, refinancing, cash repatriation, planning, and mergers and acquisitions. Leona has published articles with the Canadian Tax Foundation's Canadian Tax Focus publication and previously served as one of the contributing editors. She is a past steering committee member of the Canadian Tax Foundation's Toronto Young Practitioners Group and previously served as the Ottawa Young Practitioners Steering Committee Chair. We also have Gilbert Ling, who is going to be co-presenting with Leona. Gilbert is a manager in EY Toronto's International Tax and Transaction Services practice with 4 years of corporate and international tax compliance and advisory experience. As with Leona, Gilbert works closely with a number of global companies and assists both Canadian inbound and outbound clients on matters including restructuring, refinancing, cash repatriation planning, and mergers and acquisitions. Gilbert holds a CPA designation in Canada and graduated from University of Waterloo's Master of Taxation program. Take it away, Leona and Gilbert.
Thank you, Sonia. If we could just, Victor, if we could get our slides up. Thank you, Sonia. So we'll begin with our case study. I'll go over the background facts and assumptions of our case study, and then I'll pass it on to Leona to discuss the tax consequences to consider when investing abroad. So our background is we have a Canadian company looking into investing in Hong Kong and China. Canco, our Canadian company, is called. It runs a clothing retail business and has decided to relocate its clothing items to China. It wants to relocate the manufacturing process due to economies of scale, outsourcing, low costs. So in this regard, Canco will form a company in Hong Kong. That's HKCO. HKCO will perform all financing, HR, and legal functions in connection with ChinaCo's business. HKCO will form ChinaCo, a company incorporated under the laws of China. It will be a wholly foreign-owned enterprise. And then ChinaCo will manufacture goods, and then sell those clothing goods that it manufactures to various third-party distributors located in various jurisdictions around the world. In its manufacturing processes, ChinaCo will use the IP that HKCO has, IP and trademarks, and then ChinaCo will in turn, as consideration, pay HKCO an arm's length royalty. So that's our background, facts, and assumptions. I'll pause there, and then I'll pass it on to Leona. If we could go to the next slide to discuss the high-level repatriation process for ChinaCo repatriating all the way back to Canada.
Yeah, thanks, Gilbert. You know, we wanted to walk through the expected tax results here with this type of structure. And I mean, the webinar is all about maximizing returns. So we want to also lay out what are the key requirements in order to have this type of tax efficient structuring. So to recap, here we have HKCO, which for our purpose, it's incorporated under the laws of Hong Kong, or it could be incorporated under the laws of another country. But in all cases, we would require a company that is centrally managed in Hong Kong. So what I mean by that is a majority of the board of directors are resident of Hong Kong for tax purposes. All key decisions are made by the board while they're physically present in Hong Kong. For purposes of our, Income Tax Act in Canada, that generally sets that company would then be considered a resident of Hong Kong. And we'll have Hong Kong Co earning royalty income from China Co in respect of the intangible property as well as trademarks. And we understand that, China Co would then use that IP in its manufacturing business. So that could be, the clothing brand. It could be the sort of samples of the actual clothing itself and the intellectual property around how the clothing is manufactured. And then we have ChinaCo employing more than 5 full-time employees, and it carries on an active manufacturing operations in China. So this is a very critical requirement for a Canadian tax result. It's important because in Canada, we have what's called a foreign accrual property income, or otherwise known as FAPI regime. And FAPI regime really ensures that Canadian companies are not simply offshoring funds and earning passive income. So one of the key requirements to ensuring that you don't have FAPI issues in respect of any outbound investments is making sure that you have more than 5 full-time employees, and such company then carries on some type of active business. And in this case study example, we have an active clothing manufacturing business. So with these types of key requirements satisfied, where ChinaCo distributes its excess profits, this should be subject to a 5% withholding tax pursuant to the CEPA. So Sonia mentioned that briefly, and we'll also sort of talk about this throughout this webinar. Callan will be covering that off for us. Such distributions should not be taxable in Hong Kong, as such profits should be deemed to be derived offshore. And, in the coming section, we'll also be learning more about the Hong Kong tax regime and the overall business environment. But in any event, where profits are then distributed by Hong Kong Co to CanCo, such distributions should then be received by CanCo tax-free. So this is an example of a tax-efficient structuring, and it's ideal for maximizing the return. It steers clear of the FAPI regime in Canada, and it also allows for the profits from ChinaCo to sort of be distributed up the chain, ultimately to CanCo, and received in the hands of CanCo tax-free. So that kind of sums up the ideal structuring. Certainly it is dependent on the facts, but as mentioned, the key requirements being residency in another country, particularly one in which Canada has a tax treaty with. Secondly, having an active business in a country that Canada has a treaty with, and having more than 5 full-time employees in that company. In the case of the royalty income, while in nature that is passive, because the IP is being used by China in its active manufacturing operations, it's then deemed active business income and then not considered FAPI. So again, a lot of critical and key requirements that you need to be mindful of with this type of structuring. So we generally recommend, when doing any type of outbound structuring and ensuring that you manage the FAPI regime, it's always best to contact, work with an international tax advisor, because the FAPI regime is very complex. So that sort of sums up our case study, Sonia. I'll pass it back to you now.
Sonia, you're muted.
My apologies. Thanks so much, Leona and Gilbert, for an instructive presentation and for simplifying a rather complex situation and make it easier for all of us to understand. I would invite the audience to ask questions of Chris, Leona, and Gilbert. I'm sure you have a lot of areas where you would like them to clarify for you. Next up is the inimitable Kaylin Anderson. No stranger to those of you who have participated in other webinars and functions of the Hong Kong family. Nevertheless, we must pay tribute to Kaylin's background and talents. Kaylin is the Executive Director of Hong Kong Corporate Services Group. He is doing this from Hong Kong, and you all know that it's pretty late right now. Kaylin hails from the United Kingdom, having grown up in Edinburgh, Scotland, where he was involved in business consulting at the Edinburgh Chamber of Commerce. Kaylin has also been chairman of several non-governmental charitable entities, as well as serving a period as general manager of a United Nations infrastructure company during the Bosnian War from 1992 to 1995. Kaylin is a business specialist with significant private and public sector experience in strategic and business planning, human resource management, and corporate services. With over 25 years experience in management and consulting, Kaylin has been instrumental in assisting firms from Australia, Canada, UK, and USA to develop a presence in Hong Kong and mainland. Since Kaylin's first appointment in Asia since 1999, he has led many global firms in their expansion within the region, as well as taking up voluntary posts, including director of the Canadian Chamber of Commerce. He is a fellow of many organizations, including the Hong Kong Institute of Directors. And may I say that despite that he's a Scot, Kaylin somehow managed to become a director of the Ottawa section of HKCBA. Today, Kaylin will share with you his vast experience using Hong Kong as a base camp to leapfrog into mainland China and the rest of Asia. Please sit back, relax, and enjoy the show.
Thank you very much, Sonia. Don't be too relaxed, I might fall asleep. So it is 12:40 a.m. here. It's not that hot, I'm pleased to say, compared to the weather during the summertime. I'm going to cover a few key points and really following on from what Chris was saying and Leona. So I'm going to start this talking more about why Hong Kong is important to Canadian business. There's a number of reasons for that. You've probably read lots of the news reports about Hong Kong and its demise. It's the end of Hong Kong. China's taken over, it's the end. Well, I've been living here 21 years and it's far from that. If anything, there's been a larger flow of US dollars into our city in the last 6 months than there has been since probably 1997. And the number of listings and IPOs happening here have been quite significant. The Ant Group, of course, did not take off. It may still come back, but Hong Kong is seeing a huge resurgence. And despite the COVID situation, we've only had a small number of fatalities because of it. So we've been very lucky in that respect. So business is carried on as normal. I still go to the office every day. Cinemas are open, gyms are open. So we're still open for business, but it's still very hard to fly here from Canada. A large part of our client base is Canadian. And in the last 2 months, now we're talking 8 weeks, we've seen a huge increase in interest in opening up businesses in Hong Kong. Not just because of Hong Kong, but because of where Hong Kong is situated in the center of Asia, next to China, and also the connection to the rest of Asia as a whole. I've calculated that there was about 700 Canadian-owned companies based in Hong Kong. Now, when you say 700, there's some SMEs involved in that, and there's some very large companies, listed companies based in Hong Kong. And considering probably I helped probably set up about 80 of those companies in the last 2 years, it does grow exponentially. 64% of those firms are using Hong Kong as their headquarters. Sometimes a virtual presence when they're doing business in China, but certainly they're using Hong Kong as their base for many reasons. Interestingly enough, despite all the issues with China and Canada, this has been the best trading year for Canada with China on record. This graph shows an exponential growth. Part of that is because of PPE and the purchase of masks and other things from China. There's a two-way street. So even though we're looking at China with a bit of through rose-tinted spectacles sometimes, it's not as bad as we may see in the press. There is trade happening there. Lobsters, for instance, Canadian lobsters are selling like hotcakes in China. They don't want Boston lobsters. They don't want American lobsters because of many issues in America. So they're buying Canadian produce. This is a graph that came out from about 2 days ago, I think it was, from Goldman Sachs. And if you look at the expected recovery and GDP growth in 2020, 2021, everyone is negative apart from China. In 2020, it's the only positive number, 2% growth. And next year, as Chris also mentioned, we're looking at 7.5, if not larger growth next year. So when you're talking about business and where should I invest and what should I be selling and what should I be buying, from a Canadian point of view, there's nowhere better than Asia. Even if you ignore the China part, Asia as a whole is where it's opening up already and people are doing business. So why Hong Kong? Well, we discussed it already with Chris earlier from Invest Hong Kong. And Invest Hong Kong is a very, very good organization to get support when you're looking at going into the Hong Kong market. I compare Mount Everest. You wouldn't go to Mount Everest day one and climb the entire mountain and say, well, I'm there. It takes time. You need to have a base camp. And where better than Hong Kong for your base camp? Think of Hong Kong as the base camp, not just for China to enter the China market, which is a huge market, but also the rest of Asia. Hong Kong's got 46 different double tax treaties around the world. It's gone up by 10 in the last 18 months. And that means there's actually a benefit to using Hong Kong and trading with our neighbors around Asia. The best tax treaty in the world, and I can't find any other government that's got it, is the Hong Kong-Canada double tax treaty, where if you repatriate profits and you structure it, as Leona had said, then you can bring your profits back to Canada at 5% when CRA look at it when it gets back to Canada. So it's a great option to use Hong Kong for business outside of North America. So Hong Kong, tax-wise, we have a very liberal tax regime. Over $2 million at 16.5% profit tax above the 2 million level, and below 2 million it's 8.25%. So for startups who are thinking, well, Hong Kong's very expensive for offices, there's opportunity to come here, save on tax, grow your business gradually, and then when you get past 2 million, which is great, then you'll be paying a bit of a higher level, but it's still a very low tax regime. Remember, we have got no VAT here, so there's no real other cost. We have rule of law. Again, debatable point in all the news, but I assure you, English common law still stands very strong in Hong Kong. One of the top justices of Canada is on the High Court, Court of Final Appeal in Hong Kong. So there's trust in our system here. Many Chinese manufacturers and companies use Hong Kong now for dispute resolution. They don't always trust the law in China to do a good job. We've got no capital gains tax. So if you have a dividend from your company, you'll pay no capital gains on that dividend. A dividend is issued by your company in Hong Kong, no tax. There's no tax on dividends from shares, stock holding, or even interest on your bank account, although there's not much interest happening in bank accounts today. And we're also the preferred partner of China under a thing which we've talked about already called CEPA, the Closer Economic Partnership Agreement. So it's a very important trade deal between us and Hong Kong. Although we're part of China, we still have a border. We still have a different tax regime, a different customs regime as well, different laws. We have our own passport in Hong Kong, remember. There's a border. So we're a preferred partner to China. We also touched upon Hong Kong as a territorial tax regime. Now, I find tax very interesting, although it can be a bit tedious sometimes, but these are the key salient points. It means that Inland Revenue in Hong Kong really only care about any money you make in our city. So if you sell something here or buy something here, then your company is onshore. But if you are only selling to, let's say, China or Singapore or Thailand or Taiwan, and you have a Hong Kong business doing that, you can then tell the Inland Revenue, my income this year was offshore. You could argue that half the income was onshore and half offshore, but that gets very complicated sometimes. But you just tick a box on your profit tax return saying, I'm offshore. And then within 2 years, it takes 2 or 3 years, the IRD will come back and say, well, let's prove that you are offshore. And then it'll take another 2 years of lots of questions. When did you fly to Hong Kong? How long are you here for? But again, that's the sort of thing that firms like EY and our firm help you as a Canadian business in Hong Kong deal with. But it does mean, remember, if you are in Hong Kong, you're selling and buying from China, but nothing in Hong Kong, you won't pay profit tax in Hong Kong. We have CEPA, and as I said, although we're part of China, we have our own WTO membership. So although USA has been saying we're part of China, we are very separate in how we are considered in WTO and other jurisdictions. It's a very important trade agreement. So I'll come back to that shortly in more detail, because it's often talked about but not really explained. If you're a Canadian firm and you place your, let's say you have a parent company in Canada and you want to have a company in Hong Kong to investigate the markets in China and elsewhere. If the company in Hong Kong is 2 years plus, so it's been established for 2 years plus, you will be given the same market entry benefits as a normal native Hong Kong company. So that means you come to Hong Kong, you are then a Hong Kong-based company doing business in China or benefiting from the double tax treaties in other key markets. Now, 2 years is an important part to note. It's often skirted over. If you were to buy an off-the-shelf company that had been established over 2 years, you already achieved that goal as far as China is concerned. 3 days ago, the Regional Comprehensive Economic Partnership was also signed in Vietnam and around Asia. It doesn't include India, but it includes lots of other countries. And this is the key map of how it looks, including Australia, New Zealand. And that means covering 30% of the global GDP. It also means if you position a company in Hong Kong owned by you in Canada, you also benefit from market entry through this new regime, this new agreement that's been signed. So tariffs fall away, tax equalization happens. And all you have to do is plant your flag in Hong Kong, set up a company there, and then you can participate in these free markets, which you could not do if you came from Canada without having a limited liability company set up in Hong Kong. So I go back to, if you're a Canadian manufacturer, supplier, educator, farmer, or buyer, remember Asia is already opening for business after COVID. Even if you don't want to deal with China, I know China is not everyone's favorite cup of tea, but Hong Kong is still the best place in the world to trade with Asia. So we talked about SEPA, and I tried to find a nice picture. It's a roped off VIP area of a nightclub. Not that I go to nightclubs, but I'm sure that's how it looks. It covers trading goods, services, investment, economic and technical cooperation. So they don't understand it and what the fundamental offering of this agreement between Hong Kong and mainland China is. SEPA will grant local Hong Kong businesses the most preferential investment access to mainland China compared to anywhere else in the world. This means local investors are now treated as Chinese nationals when investing in non-service industries over the border. There's 26 categories that are not allowed. They're usually car manufacturing, petroleum, natural gas exploration, and some technology in mobile technology. The SEPA arrangement touches sectors covering legal services, accounting, and it applies to the entire mainland market, adding 28 liberalized measures. It also awards Hong Kong the most favored treatment provision. So local manufacturers in the past, they were doing a joint venture with somebody in China, they would have to sort of conduct it based on Chinese law. Under SEPA, most firms are allowed to exert full control over their company in mainland China. And the Hong Kong government is really pushing, part of Greater Bay Area, to hope that firms such as from Canada understand this. You come to Hong Kong, have a limited company set up here, you are then qualified to enter China under SEPA. There is a very important part of China and how China looks at how people invest in their country if you're not Chinese. They have 139 key areas called the negative list that you cannot engage with. So finance, legal, manufacturing of other key aspects of Chinese economy. So non-Chinese firms cannot go into the market. But Hong Kong firms are treated equally as native mainland companies. So the exemption list, the no-fly list, if you like, then disappears if you become a Hong Kong native company. So over 2 years, in 1 day, you can enter China into markets that no Canadian, Australian, or UK company can currently do, just by having your business based in Hong Kong. For tax, it provides free movement of goods and services between HK and China. Profits coming from China to Canada have a withholding tax of 10%. There's quite a lot. There's also tax in China, remember, as well. It's just a withholding amount on you bringing profits out of China. But under SEPA, this is reduced to 5% if you have a Hong Kong limited company. So as Leona had mentioned earlier, you create a company in Hong Kong with substance. The key is substance. You have board meetings. Decisions are made in Hong Kong. You have maybe staff in Hong Kong. You have board directors that come to Hong Kong. Then you can participate in this SEPA arrangement. And then the money, the withholding tax in China is 5%. You bring the money back to Canada, also potentially at 5%. So I'll give you a quick Canadian case study. I had a client involved in green tech. It's factory ventilation, and China's got really involved in providing a key for cleaning up the environment and factory pollution. And this client is based in Montreal, and they had developed the technology and the IP in Canada. Canada's very, very strong, as you all know, on green tech, but they had interest from China. But getting finished product to China, customs declarations, etc., was very, very complicated. It was also cheaper, they decided at the end of the day, to manufacture most of the technology in China by themselves than ship the finished product direct from Canada. So they decided wholly foreign-owned enterprise, which is just like a limited company. You own it entirely. There's lots of rules and regulations about it, excuse me, but that's what they decided to do. For contract safety, for tax reasons under CEPA, I always say have a Hong Kong business that owns your China structure. If things go wrong, as they can do in China, excuse me, then you can cut off the Hong Kong part of the business and it won't impact your Canadian parent company, the holding company back in Canada. So always use Hong Kong to set up the entities in China. And that's what they did. So the Canadian parent owns a Hong Kong company, then owns the WFOE in China. So the WFOE is now manufactures in China and also sells to China and the rest of Asia. Profits are reported monthly in China, and tax authorities in China usually look at quarterly payments of tax. Sometimes it's monthly in the early days. After 1 year building a business, my client, with royalty fees, management fees, and profit that they had made in China, gets approval from MOFCOM, which is the Ministry of Commerce, to repatriate the profits back to the Hong Kong holding company with the 5% withholding tax. Now, the reason it's a year is because it takes time to build up. If you start applying to send money back to Hong Kong every month or every quarter, it gets very complicated and the government will look at your books even more closely than you want. So I always suggest build up a reserve over a year and then start bringing the money back to Hong Kong. Getting money out of China is very, very difficult. It's not impossible by any stretch, but it needs to be managed properly. There's a few stages to go through. So the Tax Bureau applies the withholding tax before the funds leave for Hong Kong. Funds are then in Hong Kong and they're held in the Hong Kong bank account for the client. And then after a period of time, it could be yearly or half yearly, the Hong Kong company issues dividends. And those dividends will flow back to the Canadian parent company or individual shareholders if required. And they'll be assessed at a lower rate under the double tax treaty between Hong Kong and Canada, if you're following what Leona had said earlier. In Hong Kong, there is no capital gains on dividends. So if you make dividends in Hong Kong and you live in Hong Kong, you can buy your speedboat or your castle in the sky. So to summarize my last slide, you have your Canadian company. There is your base. You've got intellectual property there, you've got ideas, but you want to expand outside of Canada and America. Setting up a Hong Kong business, as Chris had said earlier, is very easy. There's ways to structure it, which may be more complicated sometimes, but it's a very easy process in Hong Kong. Government is very hands-off in our city. So setting up a Hong Kong company, a day and a half to 5 days, depending how quickly you get documents together. You set up a China WFOE. A WFOE in China can take 4 months to set up or 5 months. Under the free trade zones, like there's plenty of free trade zones around China, in Shanghai, you can set it up in 1 month. I don't like doing it too quickly because there's a lot of processes to go through, but you can, in practice and theory, get a WFOE set up in 4 weeks. But I would suggest you don't. I'm doing that for a client now. We started the process yesterday. We'll have the business registration document on Monday in Shanghai. But then there's a bank account, the tax registration, and that'll take another 3 weeks afterwards. So once you've got your structure all set up, the profits can then cascade back to your Canadian parent company. So I know that China is in the news and people are not very happy with China in many ways, but even if it's not China, there's a huge market in Asia who are clamoring for the Canadian flag. The brand of Canada is very, very vital to Asia. So hopefully that gives you a very quick insight into Canada, Hong Kong, and how you enter into the China market. Thank you very much.
Thanks very much. Kalen. Your presentation, as well as Leona and Gilbert's presentation, enlightening, but I think at the same time also have raised a number of questions. And of course, to the extent that the audience have a real situation, they can always contact one or all of you to get further help. For now, we are going to be dealing with a few questions that have come in. This one, I think, is perhaps addressed to Leona and Gilbert. It says, is there withholding tax on the royalty payment from China Co to Hong Kong Co according to CEPA?
Yep. So sorry, I was just on mute. Happy to address the question. I think that's a really great question. So typically, when there are royalty payments made by, you know, a mainland China business, you'd have the domestic withholding of 20%, but due to CEPA, this then gets reduced down to 7%. And then in some unique cases, let's say if it's a shipping or leasing business, this could potentially be reduced as low as 5%. But generally speaking, in light of the CEPA, it would be 7%.
Okay, thank you. Anything else to add, Gilbert or Kaylin, on this? Okay. The next question is for Chris, I think. Over the weekend, China signed the Regional Comprehensive Economic Partnership with 14 other countries. Could you provide an example of how Hong Kong can benefit from this?
Sure. Just as a caveat, Hong Kong is not yet an RCEP member. However, the city still benefits from the potential tax benefits and the smoother customs arrangements. And the advantage for Hong Kong, whether it's a member or not, is that it's an open and free economy with no tariffs or barriers. It's not even necessary to be a member to benefit from it. Right now, Hong Kong can expect to see benefits in terms of logistics, trade, and supply chain. There's going to be more trade between China and the other countries as a whole. And because of the special arrangement between Hong Kong and China, Hong Kong is going to benefit as a trading partner for most of these countries. Anytime there is an increase in trade between China and another country, because Hong Kong acts as a port of entry for China, there's going to be a benefit, whether direct or indirect. I mean, for example, most SMEs have manufacturing bases in China. So when China signs an agreement with other countries, it's going to be easier to export goods to the other 13 countries. If you think about it, Hong Kong's already got free trade agreements with ASEAN and Australia. Also, obviously with China and New Zealand. What it doesn't have is free trade agreements with Japan and South Korea. That's the only thing that's currently lacking right now. And obviously, it would be great to have those two major economies in a free trade agreement, but we're confident that it's going to come.
Okay, thank you, Chris. We have a question for, I think, Kaylin. It says, how hard is the hurdle, including approval, for the inbound investment money to China? Any special provision in CEPA to approve this investment? I guess Kaylin as well as Chris could address that.
Getting money into China is no problem at all. They love getting the money and the cash. Just give it to them. They want it. Getting the money out is always the challenge. So getting money in to invest in businesses is very easy. I think the key is, what are you going to invest in and what the structure is. I wouldn't go around investing in somebody's business without being very clear that it's a JV or it's a WOFE that you're investing in yourself, and there's agreements in place. Joint ventures have had a bit of a resurgence in the last year. I don't really like joint ventures because you have no real control. You're relying a lot on your partner who's in China to give you the right set of books. But certainly as far as investment into China, it's not a problem. There has been like VIE structures, and they were quite popular, which allows foreign firms to invest into China without much documentation or structure around it, and is really supported by people in government. The problem is, if the day they don't like you, then the VIE structure dissolves and your investment also goes too. So just be very careful what you do invest in, and make sure you can get your money out. You know what you're signing up for.
Okay, thank you. There's a question for, I guess, Leona and Gilbert. It goes something like this. I understand that after-tax profits of Hong Kong coal can be repatriated to Canco free of Canadian tax. What if the funds are left in Hong Kong coal earning interest and other types of investment income? Is this more beneficial, since I understand that Hong Kong, as Kalen is saying, does not levy tax on interest income?
I can take that, Sonia. I think that's a really great question. As I alluded to, Canada has a FAPI regime that really ensures that Canadian multinationals are not simply offshoring funds to, even if it's a treaty country, that those funds aren't offshore to just earn passive income. So where Hong Kong Co has excess funds over and above its working capital, and it sits in an account in Hong Kong, and albeit, yes, it doesn't get taxed at the Hong Kong level, it nonetheless would be considered FAPI for Canadian tax purposes, and FAPI is then taxed in the hands of the Canco at the federal and provincial corporate tax rate. So in the case of an Ontario company, we would have tax at 26.5%, the combined rate. So it isn't ideal for those funds to sit and earn interest income in Hong Kong Co, particularly if those funds are in excess of Hong Kong Co's working capital needs. But if, for example, those funds are held by Hong Kong Co because from time to time they have costs that they need to incur, salary costs in respect of their HR team, finance team, etc., then arguably the interest income would be considered incidental to its business and thus not FAPI. So it really depends on the facts, but in summary, ideally, you don't want to be leaving funds in excess in either Hong Kong Co or China Co and having it earn any passive income.
That's great, I guess, except for using that to buy a yacht, as recommended by Caleb. Thank you, Leona.
At the moment just now, there's no interest really being gathered on any currency at the moment, and euros are now negative interest. So even in Hong Kong, if you've got a lot of money sitting in the bank in euros, you're going to lose money every year or every month on that investment. I have a client in Europe, 13 million euros. He's charged 50,000 euros a year in negative interest. So you don't make much money in interest in Hong Kong at the moment.
Do you see, Kalen, just further to that, do you see people putting money in renminbi?
Some Hong Kong people.
Does that provide you with a higher interest rate?
It used to. Renminbi has also gone down a bit in the last few months. There's now the digital renminbi coming on board to compete with the USD. It's going to be very interesting. But most people in Hong Kong are really into investing in things, stock market for one. But if there's a company, they're looking at how do they expand their business? How do they maybe buy up other distressed assets to bring into their company and then grow the Asian operations?
Okay, thank you. We have two more questions for Kalen. This one here, if you do not feel that you want to address, that's fine. It goes like this: any economic dramatic impact from the latest BNO exodus?
Well, BNO is British National Overseas Passport holders, and BNO was given to everybody, a lot of people in Hong Kong after the handover. There is no exodus. The news talks about everyone's leaving for the border to leave in planes. I have signed 32 applications for BNO renewals for staff and clients in Hong Kong, but they're not leaving. Hong Kong is their home, it's my home, and it'd take a lot more than the last year's protests and government interference to make them want to leave for Alberta in the winter, or Winnipeg, or even Edinburgh in the winter. So there's not an exodus. Lots of governments have offered the right to people to leave, even including Canada. Canada announced this week that they'd let students come into Canada, and after a year, they get residency in Canada. But nobody's leaving en masse. It's not like after the handover or before the handover, people left for Canada or Australia or UK. People are still staying here. There's no real day-to-day change. No matter what you see in the news, it's all hyperbole.
Thank you, Kalen. It's always refreshing to hear your point of view, you know, from the grounds, and ignore all the noise. Thank you. One other question. It says, it's addressed to Kalen, with Hong Kong Coal setting out to sell to Chinese consumers via cross-border platforms. Will there be any obstacles to repatriate the sales back to Canada? I believe it says on an ongoing basis.
So we talk about platforms, you might be talking about e-business, I'm guessing. So if you're in Canada and you're selling on Alibaba's platform to China and selling, it's up to the people in China to pay you before you deliver goods. I think it's 40% of all items on Amazon globally are from Shenzhen, manufactured in Shenzhen. So there's ways to get paid. If you're not doing it online and it's maybe you're selling maybe wine or Canadian beef to Canada, again, it's about, do you have a supplier and a contact point in China to take this product for you and make sure that you get the money for it? China's difficult. If it was easy, I'd have no job. So again, it's case by case. The goalposts move day to day. So seek out advice. Invest Hong Kong, EY or myself, we can give advice on how to do it. But it's not so easy just to say, can I sell to China on a platform, get it back? What's the platform? How much are you selling? Who are you selling to? All these kind of things make the picture of how to do it. And it's not always that difficult. You're muted again.
You're muted. Sonia, you're muted.
So sorry. Thank you, Kalen. For now, that's all the questions we have. And we are almost time, right? Zohair?
Yes, absolutely. And time has really gone very, very fast. I'm just checking the attendance. We have 100% attendance, which is fantastic. Everyone who registered has attended. It's good to see that, and so they must have stayed because there was good content and a good panel of speakers as well. So and moderator, of course. So thank you very, very much. It was really fascinating and so much information today, and I'm sure there are going to be people with more questions. And a little bit later, I will be putting up our email address so that they will be able to ask questions. Everyone who has attended will receive an email from us asking them if they have more questions, and they will revert to me. I will revert back to the speakers. We are recording this session, so anyone who wants to have a copy of the session, I will certainly just send me a request and I will send it to them. Also, to all the registrants, they will get an email with the YouTube link of the webinar. I think it's time for me to thank everybody. This is really a wonderful webinar. And I want to start from the first speaker, Christopher Chen from Invest Hong Kong. He's been a regular contributor, and we appreciate that. Leona and Gilbert from Ernst & Young. They're new to us, but hopefully we'll be seeing you more often, Leona and Gilbert. Callan, oh, I don't have to talk about him. He's a regular. He's part of the furniture here, so which is fantastic.
The eye bags.
And with the eyebrows, yeah. Of course, we have to. I want to thank Emily and Stephen Phillips for their opening remarks, their warm opening remarks. I appreciate that. Our sponsors are very, very important. The Hong Kong Economic and Trade Office in Toronto and in West Hong Kong, the Hong Kong Trade Development Council, Sonia Chong Professional Corporation, Ernst & Young, the Hong Kong Corporate Services Group. I'm not sure why Royal Bank is over here, but maybe from a previous one. Okay. Next slide for me, Victor, please. Of course, we are always grateful to our attendees. They've been very, very good. They've stayed, most of them have stayed to the end, and we really appreciate their time to join us from both Hong Kong and Canada, of course. Plus, of course, our family, our Hong Kong family supporters, which include the Association of Chinese Canadian Entrepreneurs, Mississauga Chinese Business Association, Toronto Chinese, Scarborough and York Region Chinese, Markham, Richmond Hill, Vaughan, and so on. A special thanks, of course, who's contributed so much to the technical side is Victor and Haley Ng and Gigi Chan, who have been helping quite a lot with our social media distribution. So thank you very much for that. Excuse me. So if you can, the next slide. And now I really would like to thank Sonia. Sonia is really the glue that put everything together. She wears many hats, and I'm glad that she took time to work with us and would work with the webinar team to make it such a successful event. She's got really good knowledge about the topic, which I'm so grateful for because I have absolutely no knowledge of tax. So she stepped in very, very well. And she has been incredibly supportive to both the running, organizing, and the planning, organizing, and the actual webinar. So very much thank you to Sonia.
Thank you, Zohair. Can I just mention one thing? Special thanks to Arthur Chen, who is our HKCBA National Chair. He's the one who put us in touch with Leona and Gilbert. Thank you, Arthur.
Thank you very much for that. So so here is my email. So if you have questions and requests for the video, please do send it to me. One additional thing I want to add is if you have any additional tax-related topics that you would like for us to present, please let us know, because we have all these experts here, and we are. I'm sure we're ready to do other tax-related webinars in the near future. We are already planning for 2021, so please do let us know. This is the right email to send it to. Of course, if you want to join us as well as a member, we have now individual membership, lifetime individual membership with just one payment. Also, this is the email to contact us with. Let me just quickly go through my notes, and that's essentially it. You know, it has been really a great opportunity for everyone to share their perspectives on this. And as a whole, I think we all benefit from this. So a big thank you to everyone today, the attendees, and also our speakers and our background people as well. You know, thank you for your time, for spending time to watch us and learn. Okay, so for the rest of the day, I wish you the best, and that's it. We are done.
Good night, Kaylin.
Good night, Galen. Yeah.
Hey.
Have a good nap. Yeah.
All right.
Okay,
Bye, everybody.
Thank you, everybody.
Thank
Okay.
you.
Bye-bye. Bye-bye.
Bye.